Thank you. Welcome to the last presentation of this stream. Last but not least, we have Nick Cubrilovic. Nick is an independent security consultant. His presentation is titled Stock Hacks. Please welcome Nick to the stage.
Good day, everyone. Last but not least. Okay. So, this is something I've been working on for a couple of years, provisionally titled Stock Hacks. So, a bit about me. I'm Nick Cubrilovic. That's my website, nickcub.com, and Twitter handle. I've been an independent security researcher for a couple of years now, worked at a number of different startups. I've been doing research probably since the mid-90s or so. The main thing I'm interested in at the moment is applying what we learn in InfoSec to different industries. And this is how this came about. It's an application of what we work on in information security in the financial sector. And it's about things that we might take for granted in our work, in penetration testing and in security auditing, and how that's applied in different industries. So the subtitle of this talk and the accompanying paper, which is going to be published this weekend or on Monday, is applying open source intelligence and information leakage in an event-based trading strategy. So that might seem a bit intimidating at first if you're not familiar with the financial sector or with trading stocks, but we're going to unpack this phrase and break down the different terminology in there and what it means throughout this talk and in the paper. So the paper will have a bit more detail. There's a bit of statistics and math involved, and the presentation here will just have a sort of overview of it. So the first thing we're going to define and look at is event-based trading. How many people here, just out of curiosity, trade stocks directly? So most people have an idea. Know what short selling and long selling is and sort of how it works. So here's a stock chart for Apple for the last quarter, I believe, up until about a week ago. And if we look at this here, we can see that there's a bit of a variance in the price, but something interesting has gone on here with this big drop in the price, where it's gone from $104 to $96 or so. So we're going to have a look at what it was that happened on that date. If we look backwards, it's the 26th of April, and what happened on that day is Apple announced quarterly sales results. And it was significant because it was the first time in 14 or 15 years that Apple actually saw a reduction in their revenue. And that was driven by a sales drop in iPhone sales for the first time. So that is what we refer to in the financial sector as an event. The company said that it sold 51 million iPhones in that quarter, which was down from 61 million from a year earlier. So if we have a look at those numbers, that's 10 million less iPhones that they've sold in 12 months' time, which works out to be about a 16.4% drop. So when we talk about event-based trading, we're talking about, we know that that's going to come up. We know that there's going to be an announcement. They're going to announce some figures. The trading is all about coming into or out of the stock before and after that event and making a prediction on what you believe the stock is going to do at that event and then profiting from it. So there's a whole series of hedge funds out there. You know, there's the Warren Buffett strategy of buying blue chip stocks and holding onto them for 10 years, which is what a lot of superannuation funds do. But then there are a lot of hedge funds who might have a fund of 4, 5, $10 billion, and they'll be out of all stocks for 88 days of the quarter. But then leading up to and after these events, they'd be into the stock for a couple of $1 billion, if not more. And that's predicated on what they believe will happen during that event. So in this instance, the stock dropped 8.3%, down to $95. If we zoom in on the actual event here, we can see that this mostly happened in after-hours trading. And then all that an event-based trade would be around this announcement would be buying and then selling afterwards, whereas in this case, it's a short sell, so you'd sell beforehand and then buy back afterwards to capture that trade. 8.3%, so, on $1 million, you're looking at $80,000. The one thing that we've got to keep in mind when we talk about returns is that 8.3% doesn't sound like much, but in a lot of these cases, you trade on margin, and that's accessible to consumers now through companies like CMC Markets, who offer, for as little as a $10,000 deposit, they'll give you 20 to 1, 5% margin, which turns that 8.3% potential return into 166% potential return. So when we talk about returns here, it's one of the things to keep in mind. Some of these, 0.4%, 0.5%, 1.5% might not sound like much, but in a 24-hour period trading on margin annualized, the returns are, potentially huge. So as part of that announcement with the Apple event, the reporting also talked about how their guidance had missed analyst expectations. And I assume most of you know what expectations are. The CFO of a company would come out each quarter and they would say, for the next 3 months we're expecting this, for the next 12 months we're anticipating this, and they sort of offer what their view is of the upcoming quarter and the upcoming year. And this leads to news headlines, which I'm sure you've all seen, that talk about earnings misses, earnings hits, revenue hits and revenue misses. And all that means is if a company's results matched or didn't match the expectations that they'd laid out. So here where we come to what we're talking about. So we've got 108%, 166% return on iPhone sales dropping 16%. What if we knew that iPhone sales were down? So this is what a lot of analysts do, a lot of hedge funds. They sit down and they use as much public data as they can to try and figure out if sales are down, if sales are up, how many people are buying, how many people are selling, and then they try and make a prediction based on that, and then they trade on that information. Almost everything in the economy that we do, buying things, selling things, trading, leaves a wake. So the best way to visualize this is if you think about, a huge ship passing through the ocean, it will leave behind markers that something's going on. So for instance, in the iPhone example, the wake is that you can't move 55 million iPhones without trucks, ships, salespeople, stores being open, phones being fixed. If you think about it from everywhere from the design process through to the manufacturing process, through to it getting it into stores, getting it into people's hands, the credit card transactions, the sales support, the queues. So all these things are out there that you can observe indirectly to then try and statistically come up with the main number that you're looking for, and that is the sales figures. So there are a number of hedge funds that do this right now. One of the more obvious ones is you take these big meta research reports. So for instance, there might be a research report that comes out and says, overall IT spending for the next 12 months is expected to decrease 4%. So you might, propagate that and plug it into your own model and figure out what the iPhone sales numbers can do. One interesting example is a hedge fund. What they did, they went out and hired 300 people or so. They went to Apple stores all over the world. They would pull an iPhone off the shelf and they'd write down the serial number. And they'll send all the serial numbers back into the main office, and the guys there would sit down and figure out how many iPhones were being manufactured based on the serial numbers. And then I'd come up with a model based on that. And that worked. Another thing they do, what another fund done, is they'd simply walk into the stores and talk to the staff. How are sales doing? How is it compared to a year ago? And most staff, talk about this stuff, just in striking up a conversation. And that model has been very successful as well in doing end retail store surveys or doing end user surveys. And this sort of brings us to the next topic, which is high-tech based event trading. So those approaches of talking to staff or pulling serial numbers, they're pretty straightforward or pretty unsophisticated. About 2 years ago, the Wall Street Journal came out with a story where they profiled some of these techniques. So here's the thing with the financial industry is that a lot of these funds are very secretive. So for instance, in that serial number case, that first came about 4 or 5 years ago. They kept it to themselves before people started figuring out what was going on. And now, you can buy that report or buy those estimates, and everyone's got the same information, so the traders don't really have much of an edge, which has pushed them further into developing more advanced techniques. And that's what the Wall Street Journal was profiling in this story, in what was sort of the first public outing of some of these more advanced techniques, which I'm about to go over now. So the first one that the Wall Street Journal talked about is a company called Genscape. So a lot of these companies, you probably haven't heard of them. People in the hedge fund business know who they are. They probably won't talk to you for less than 6 figures a year in buying their reports, and even in that case, you just become one of their customers. So here's what they did. This is their first product. They are an energy commodity tracker. So they track all the big main commodities, oil and so forth. What they did for oil is, in the United States, which consumes about 12 million barrels a day, 80 to 90% of the oil passes through a single point in Cushing, Oklahoma, where it's placed into storage tanks, then either taken off onto ships, which they're starting to do now because they've got a production glut, or it's imported from Saudi Arabia or from the Arab states. So what Genscape did is they went out and hired a fleet of helicopters and they put infrared cameras on them. And they flew over all the storage tanks and they took storage levels. And they did this every day, and they've been doing it for 4 or 5 years. Based on that, they could come up with how full these storage tanks are and then know what the production levels are at. Every week in the USA, the government, an agency called EIA, comes out with the hard figures of what the numbers are at Cushing and what's in storage. So that number would come out and then trades would be done based on an oil price going up or down. Between July and November of 2014, the Genscape report correctly predicted every single EIA report for that entire period, accurate to 0.1%. And their customers made an absolute fortune on the plummeting oil price. That's the first example. Second example is investment bank UBS, their investment branch. So they put out a report on Walmart for their customers, and one of the paragraphs or conclusions was, UBS proprietary satellite parking lot fill rate analysis points to an interesting cadence intra-quarter and potential upside to our view. So in plain English, what they're saying is to buy Walmart stock because they've done some magic and concluded that there's intra-quarter potential upside. The way they've done this was they went out and purchased satellite imagery for every single Walmart store in the United States. They actually leased a couple of satellites. There's a lot of excess capacity apparently. And they split up all the car parks, and then every day they would count the number of cars in every car park and then plot that out. And then they would see any reduction or spike in Walmart car traffic, hence foot traffic, hence revenue, and they would put that out in their report, and they were also correct and made their clients a killing. To the point where I don't even think they share this information anymore because it's so good. So they've done that for all the retailers now. And there are probably a dozen or so hedge funds now trading on this information, and it's become a lot more common to the point where, there is no longer excess satellite imagery capacity to go out and buy on the cheap. Interesting startup that just launched about 12 months ago. They've been private for about 9 months, called Second Measure. What they did is they went and partnered with a bank whose name they don't want to disclose, and they took their credit card data. They anonymized it, but they took all their credit card transaction data. I think they went back a couple of years. And what they do now for their clients is they produce reports on retail traffic based on credit card transactions at all the major retailers in the United States. It sounds scary, but they assure us that it's all anonymized and it's not personalized. So, I don't know if people probably heard that Chipotle went through a bit of an incident last year. I think they found E. coli in the food, which I thought that was part of the menu, but apparently it led to a disaster for them. There's a lot of talk leading up to their quarterly results on how much of an impact this E. coli outbreak would have on the company. Second Measure nailed it. They knew before the market, because of the credit card data. Their customers, I think they only had a handful of customers at the time, again, traded on this information. Most of the market thought Chipotle had recovered pretty well based on other numbers, but the stock ended up falling 15 or 16% when the quarterly results came out, and it showed that the numbers were being absolutely killed in terms of their traffic. And also from this, they could tell where the customers that used to go to Chipotle, where they were now going and spending their money on takeaway. So they made those bets as well. So second measure, they've actually closed off access to the reports now. It's working really well. But again, that's 6 figures worth of research to get a chance to talk to them and to get some of this data from them. And they're expanding now into other areas. Another example that independent hedge funds have been doing is they've been pulling Foursquare check-in data for retail traffic. So Foursquare have an API. Hedge funds went out and pretended to be a tech startup or whatever and pulled all the data down and started producing reports on retail foot traffic, different retailers, and then trading on this information. And then Foursquare wisened up to what was happening, and they decided to shut it down and then do it themselves and sell the research. Well, actually, I don't know if they're selling the research, but they definitely increased the cost of scraping data for check-ins from their API. So if you start thinking about this, it sort of raises possibilities of, if you've got Google search data, trends data. I mean, trends has long been used by hedge funds. But Facebook check-in data and all the different ways that we're leaving awake now when we buy stuff in the retail space and other space, and then trading on these companies. So, example of going the other way. There's a company in Canada called Sino-Forest Corporation. There was this trend for a period of Chinese companies listing and raising capital in the West. On the NASDAQ, there were a few in Australia. This one was in Canada. Their prospectus came out, I think it was 2011, 2012, and they claimed that they were the largest privately owned forestry company in China, that they managed 750,000 acres of prime forest directly and then managed another 750,000 acres for other concerns and other owners. So they listed on the Canadian Stock Exchange. They raised a couple of $1 billion. They had a market cap of $5 billion. At the time, there was so much demand for the Chinese boom that investors were falling over each other to buy into these companies, and they drove the price up. But not everyone believed them, thankfully. There's a guy, Muddy Waters Research, who's become very famous for researching companies and mostly shorting them. He went through a whole phase of just taking down these Chinese companies one by one, which was very fascinating to watch. And this is probably his most well-known example is Sino-Forest. So what he did is he listened to the numbers and he thought, $5 billion valuation for logging, it just sounds ridiculous, right? It's such a commodity business. It's so easy to get into. You got the risk of the Chinese market. On top of that, 1.5 million hectares works out to be, 1,000 kilometres by 15 kilometres, I think it is, of forest. And he looked at their claims that they were making and all the different areas of forest that they had on their maps and figured out that at the rate that they were logging, that they would have logged out most of their forest within a couple of years, but there weren't enough trucks in those parts of China to carry all the wood or ships, let alone to make up for what the whole reporting on the thing. So he went out, he got private detectives on the roads, he got guys following all the trucks and taking down tag license plates. He interviewed the drivers. He bought satellite imagery. He did everything he could to research these claims that these guys were making. And he found that they owned nothing, right? So he shorted the stock. And it was very controversial at the time because he came out short the stock and he released a report at the same time. If you Google their name with Sino-Forest, he produced a 30-page report. The Chinese company and a lot of other investors bracketed him as a fraudulent short seller. And that's where you short sell a stock, you print something, and then in the time it takes to validate what you've said bad about the company, you've already made your money, so you you sell out. And this does happen. So it actually took him a year or so to prove his claim. And in that time, the stock kept going up. And now there was an investigation in Canadian Parliament over it, and he turned out to be right. And he's gone on and done these for a dozen other. Fascinating guy. He's using all this modern technology to run his due diligence on these companies and to uncover frauds. There are a couple in Australia as well. Actually, you don't really hear about them, but I bet almost all of us in this room have at some point had some part of our superannuation invested in some of these companies. So that leads us to internet companies. So we've forest companies selling physical products, oil tankers. But as we know, there are a lot of web companies that are public companies now. Amazon, Microsoft, Facebook, a whole bunch of them. There are dozens and dozens of them. These techniques work on these real-life companies that are shipping real-life goods. What are the techniques that we can use to run similar patterns against purely web-based companies and figure out how big they are, how many customers they have, if they're telling the truth, and then potentially trading on that information? And that's where information security and the techniques that we apply in InfoSec can come in handy. So back to the sort of sub-headline of the paper, applying open source intelligence and information leakage in an event-based trading. So we know what event-based trading is. Open source intelligence is simply any intelligence that you can collect on a target from publicly available sources. Usually, in penetration testing, it's usually your first step. Like in all these standards, it says for your first step, go out and collect as much information about the target that you can. And when we do this in penetration testing, that information is a step towards your goal. Your goal isn't to trade the stock. Your goal is to break into the network. So you go out and collect how many servers they have, what platforms they're running, what the administrator email addresses are, how many domain names they own. And we've never really attributed value to that information because it was like a stepping stone to a bigger goal. But we can see now that in the finance world, this information has value. So 2 forms of OSINT, passive and active. We'll just run through a couple of examples. This is a good one. Passive example of, how would you, if you had a target in mind, let's say Westpac. Actually, I'm not going to use any names. I was told not to use names. Bank W. If you wanted to find customers of Bank W, I'm going to use their name. If you wanted to find customers of Westpac, how would you go about it? All right, so you sit down and sort of think about this. You can, most phishing campaigns today, well, it's either or. So most phishing campaigns today, they're not very sophisticated. So they'll get an email list of 100 million users, and they would email all of them saying, go log into your Westpac account. And if you're not a Westpac customer, you just know that it's BS right away. So how can you refine that to actually target their customers? Thankfully, what a lot of companies are doing today is running support on social networks. So if you go to their Twitter account or to their Facebook account, you'll see people say things like, I tried logging into my Westpac and I can't log in. You just scrape all them and you've got a set of Westpac users. I don't think anyone's really thought about how valuable it is to know that someone's a customer of a bank, but all their social accounts say, come on and message us about your customer support problems. It's just crazy. Same, Big Pond and all these other companies as well. So that's how you can, so the theory here is you can find specific customers, which is a risk, but you can also figure out how many active users they have, because you then take a set for all their competitors and you figure out how many customer support calls each one of them has and use that to sort of scale how many actual users they have. But how would you find the exact number of users they have? So that's sort of statistical estimates, and the math that goes into the statistical elements isn't really super complicated. Like you take a known set size and then you sample it and then you multiply it out. But there are also methods in InfoSec for how we find hard numbers. Who knows the German tank problem? Right. During the Second World War, the Allies had no idea how many tanks the Germans were producing, but they wanted to figure out a way of doing it. They had spies on the ground, and they counted satellite and aerial imagery and tried all sorts of other things, but every time they showed up on the front, there seemed to be more tanks than what they knew of. So German tank solution was come up by some mathematician somewhere in the UK. His solution was, let's get our spies on the ground to write down the serial numbers of the tanks as they see them, as they come past, and have them send it back to us. And he came up with a formula. Take the biggest number you see, add 1 to it, divide it, multiply it by a sample size, and it turns out you get a really good estimate of how many tanks there are, to the point where, we won the war. I'm not sure if you heard about it. So the same thing applies in web applications. How many times have you seen this on a web app in a URL? Right, a number. A lot of the web application frameworks do this by default, where they expose the database ID in the URL, or they expose it in the data messages in post responses and replies. So all you've got to do to find out how many users they have is create a user account, get the user ID, and that's your number. Or you make observations of traffic and then sample it again and just plug it into the German tank algorithm to come back with an accurate measure. This is why 10, 12 years ago, a lot of guys in InfoSec were saying that auto increment is harmful because it gives an attacker a lot of information about your application. And when you're running an SQL injection or any type of other exploit where you need to know the ID of a user to update a record, you just put in 1 and you often hit, and put in 4 and you often hit. So the recommendation has long been to obfuscate or hide your internal structure from the outside world. An interesting example, Facebook learnt this the hard way, but they're the only company that's fixed it so far. In version 2 of the Facebook API, what you used to do is you'd get an OAuth token and you'd make requests on behalf of the user, and you would use their real user ID. And what Facebook found out these guys were doing, the ad networks they were integrating with were merging all the data together across all the different apps by using the user IDs so that they could track you across different apps that you were using. So in the new version of their API, they scoped every app on a per app basis. So if I approve the New York Times news application, they don't see my real user ID. They see a user ID that's been generated just for the New York Times. And then when they make a request, Facebook translates it back into my real user ID. And they do that with posts, they do that with everything, so that the app integrator doesn't see everything about my account and then can't link it anywhere else. They're the first to do this. No one else has really done it yet. And I'm pretty sure they're going to find out the hard way that they're going to have to do it. But Facebook's implementation is really nice, if you want to have a look at it. So then you see, a lot of people learn not to use auto increment, so then they start using GUIDs or UUIDs or random numbers. That looks random, right? But more often than not, random numbers generated by databases, especially NoSQL databases or different frameworks, aren't actually random. If you look at the source code and you break it down, what they often do is, it's machine ID, process ID, timestamp, and then, a tiny chunk of random at the end. So what looks like a 128-bit address space, you can actually start flicking the bits off really quickly and narrowing down to, a space that you can hit. And I've got an example of where I did this and it worked. So it's not just like a hypothetical demonstration that, simply by using 128-bit or 64-bit numbers that you're safe. So information leakage. So information leakage is essentially disclosure of information that describes a system. So it's the platform that's running, the number of servers there are. I sort of refer to it as the metadata. You got like the hard data, which would be your username. The metadata would be a time that you've logged in, and then the metadata would be which server you're accessing at the time. So an example, a lot of server vendors report their database versions and what database you're running. So if you sweep the whole internet, you can get an idea for how many instances of SQL Server there are, how many instances of Oracle there are. A lot of them are behind the firewall as well, but you can often probe them through web applications as well. A lot of web applications expose what sort of systems are running in the background. And again, this is one of those features where in a penetration test, detecting the database version running in the background is something you do as part of executing a SQL injection, but that's the only reason you'd use that. You wouldn't think to use that for anything else. And in this case, and there's an example of this, we can build information that we can trade on. So everyone does this, right? Everyone's learnt that you say username or password is incorrect because you don't want to tell them that the username is valid. So otherwise you can enumerate usernames. And this is good practice. Everyone's doing this now. A lot of web applications are doing it by default. But then, you scroll down half a page and it gives you this, where, oh, sorry, that username's taken, try this one. So sort of defeats the purpose. And you can use these endpoints to enumerate usernames. I mean, in the Google's case, a lot of other cases, it actually suggests to you the next available username. So the way you use this to figure out how many users they have is you take a leaked database. Let's say you take LinkedIn data where you know it's 180 million users. You take one of those sets. You take a set where you've got 10 million users that you know is like a known set, and then you take a smaller one that might have 10,000 users in it, and you sample those usernames against this endpoint, and they're often not throttled or anything like that. You can throw tens of millions of requests at it, and then you figure out how many hits you get, then you just work backwards and you get a username, a user size sample pretty quickly. Actually, the better way to explain this is this. So my preferred username is NIK. My second preferred username is NIKCUB. That's not available. If that's not available, then I use my surname, Cubrilovic. If that's not available, I use Cubrilovic 80 or whatever. You can tell how popular a service is by which username I have to pick. So on a service that launched yesterday with 10 users, I would get my first username, right? If it was slightly more popular, I'd have to use the second username option. If it was slightly a bit more popular, use a third. So with enough requests and enough known sets, you can come up with really accurate estimations for user-based sizes. And this doesn't just apply to usernames if you want to find out how many users they have. For instance, if there's a cloud hosting company, you want to figure out how many servers they have, you can use server host names. Azure from Microsoft uses server host names where the namespace is across the entire platform. And for a really long time with Amazon, before they started breaking out their AWS revenue, there was a sport within hedge funds trying to figure out how big AWS is and how much it's worth to the bottom line. And the guy that figured it out, but didn't tell anyone until later, did exactly that. So putting all this together and sort of applying what we know from InfoSec to the financial market and some examples. So these are real life examples. So passive OSINT. So I advise venture capital funds. I noticed who here has used DigitalOcean, the hosting company. They're a really popular hosting company in the United States. So we noticed on doing just ping sweeps and net sweeps that they were growing really, really quickly. This is in early 2013. So we took that, we approached the company. They just finished raising their first round of venture financing, and we got in and made an investment in DigitalOcean. That's now become, I can't disclose the exact returns, but they've grown to be the second largest hosting company in the world. And I think it's the second best return that venture capital firm has after Uber. So active OSINT, an example there with user number enumeration. So who knows the story about Adobe? Adobe, they had desktop software for a long time. And then a few years ago, they decided to start transitioning all their customers to Creative Cloud, which is a subscription-based service. And the whole future of the company depended on this transition from software licensing model on the desktop to a new revenue and services model. So every quarter, analysts would watch this one number, and that one number was the number of Creative Cloud subscribers that they'd gained in that previous 3 months, to see if they were on track to rescue their old software business and transition it to the new world of services. 18 months ago, I started tracking the number of users they have. Their backend was on AWS. They use SimpleDB and large user IDs. Come up with I've just followed it for probably 12 months. And then December of last year, they reported, I think it was 4.5 million more Creative Cloud subscribers than what they were expected to have, but I knew that already. Traded on the information, and the stock popped 8, 9, 10%. I've got heaps more examples. So it's a sort of new field that we're developing. And yeah, as I said, the paper will be out on Monday. Is this legal? Probably should have asked that earlier. So there's a bit of a grey line in terms of insider information. This is considered trading on publicly accessible information, as long as you don't cross the line in terms of service from a hosting provider or from a company or from an information security perspective, then you're pretty much in the clear. But it's still a bit borderline. I'm sort of figuring that part out. So the paper. Is this being streamed? So yeah, the paper will be out this weekend on Monday. There's a lot more examples there, a lot more hard math in it, and a lot more advanced examples of how to enumerate information from public companies and then trading on it. Thanks. Questions?
You in lithium at the moment?
No. I usually don't. What I hold is index. So when I do anything, it's more short term. So more suited to it. I mean, there's not much. You just got to spend way too much time on it and too much research time. So yeah, if anyone has anything, my email is. Oops. Actually, is anyone coming away from this conference actually learning a new way to either attack or defend yourselves from an InfoSec perspective? No? All right. I've got really good O-Day I was going to talk about, but I'm not. That's what they all say. So yeah, email, Twitter handle, name. Thanks.